Hey everyone, it's Imran from Options Insight, back with another macro option spotlight. Okay, stocks managed to end in the green yesterday, chopped around a little bit, but Powell did reaffirm the hawkish message in the second day of his testimony, but did say that no decision had been made on the March FOMC yet, whether they were going to go 25 or 50, and that makes the data points that are going to come out, like non-farms and CPI, even more important. So it's very data dependent and saying no decision has been made. China also continued to drift a bit. Weaker inflation data coming in there. Still really struggling to find its feet. China, even though we are seeing signs of the reopening kind of taking hold, remains to be seen if that's going to be good for stocks and when that's going to be good for stocks. Still not really seeing the stimulus that they had kind of promised there. And then commodities did remain heavy, but starting to stabilize, slowing down the descent. Although oil was down 1%, nat gas was down 2%, but copper did manage to bounce, hold on to that $4 support level that it keeps on toying with. Volatility-wise, gave back a little bit of the gain in vol, particularly on Nasdaq and Russell. S&P vol's pretty much unchanged, but Asian vol's firming up. China and Nikkei there a little bit higher. VVIX though, that's the vol of the VIX getting slammed again down to recent lows. Carry picture wise, we've got a load of green still for the US indices. Europe and China still the ones that are moving. FTSE and Nikkei not so much. So no real change in the equity carry picture. And then across commodities, nothing really in the green. So we're seeing red, seeing silver moving, seeing nat gas moving and copper moving, and then pretty much neutral everywhere else. So it does look like gamma shorts are probably not the most sensible thing, given that the way commodities are moving already, and the fact that we've got these two big macro catalysts in front of us. You'd probably want to stay away from being short gamma in commods, at least right now. Equity skew, mixed. Nasdaq was higher. European skews drifting a bit. And then in commodities, we saw nat gas skew bouncing again, staying pretty firm near the highs. Silver skew finally pulling back a bit, but still in the 90 percentiles. But we had flagged that silver skew looked expensive here. And we thought that selling puts in silver might make a bit of sense if you're happy to underwrite. Okay, looking at the charts, wings for sale. So interesting observation from the Goldman's vol desk. They've got a chart here where they plot the S&P wings divided by the guts. So ratio of the implied vol of out of the money options, which we call wings, divided by the at the monies, which we call the guts, right? And that's to get a relative pricing on whether people are paying up for those wingy options or whether they're not, basically, right? Now, typically when volatility gets crushed down to very, very low levels, the wings then tend to catch a bit of a premium and trade at a premium. But when vols are mid-range to high, those wings kind of softened and don't trade as expensive, right? So what we're seeing here is wings are pretty much at the lows if we go back a few years relative to the ats. And what does that mean? That means that the options market kind of believes in mean reversion right now, right? If you're not paying up for the wings, it means you kind of probably think that even if we move up, we're going to gravitate back down. If we move down, we're going to bounce, and we're going to kind of be range bound, pretty much like we have been on the S&P since last summer. So that's what the option market is probably starting to price in, taking away some of that wing premium, because we've not really managed to get into any real trends. We've just been ranging for quite some time in quite a wide range. Okay. Now, we actually like this setup when the wings are cheap, because the way we generally like to sell volatility is via short the guts and long the wings. And in iron condor type strategies, that's one of our most favorite common strategies to sell vol, to play a range bound market, is where you sell a strangle and then you buy a strangle around it to cap your downside so you can't lose more than a defined amount. And when wings are trading cheap, generally that is going to look like a more attractive trade in terms of the way it prices, because you're owning those wings. And you can also do a variation of that called a butterfly, where you might sell a straddle and then you'll buy a strangle against it. And again, you're playing that you're going to stay in the middle in the range, but if you break out of that range, you're covered because you bought those wings against it. Now, another way wings are traded, another way to think about wings is in VIX options. Okay, so if you buy VIX options, typically you're paying a fixed premium, and that's the most that you can lose. And it's another way of kind of buying wings, right? Or buying convexity. And if we look at what Spot Gamma have put out on this recently, they're saying the open interest in VIX options is actually quite high. So even though people are saying that the VIX is kind of irrelevant these days or whatever, well, VIX options markets are still pretty trading in quite high volume. Okay, and you can see here you've got the expiries along here, you've got the strikes along here, and then they've color coded this for open interest. So the light blue is where you get the big clips of open interest. So you can see there's a load of short dated calls in the kind of 23 to 28 area, and as you go to longer maturities, you've got big clips of 30 to 32 there. If you go higher up, you even see a load of open interest in quite big size in the 40 strikes all the way up to the kind of 80 strikes, right? So lots of call open interest on the VIX. We've talked about this, you know, we've got our own sort of screen that we look at for VIX, and we've shown that. Now, looking at the put side of things, a trade that we like to do to fade vol quite a lot is to buy VIX puts. You can see here the majority of VIX put open interest is sitting on this kind of 20 to 15 strike area, and it's very short dated. It's like the 22nd of March. And you know, you have got some stuff in April, but that's pretty much it, right? Beyond April, there's not a ton of open interest. So you can see when people are playing the downside in VIX, they tend to concentrate on shorter maturities because they're trying to play that VIX roll down where that curve goes into a steep contango and the front really gets sold. Whereas on the upside in VIX, people are much more comfortable owning longer term maturities as hedges that just park themselves in the book, and they can hold those for 3 months, 6 months, whatever it is, and they can hold it in very high strikes because they're just that those things will come alive in a crash, and that can happen, you know, overnight or in a really short space of time. Whereas when you're playing the downside of the VIX, you need to be a little bit more specific about your timing, go short dated, and play that steepening and that roll down of the vol getting hit. And these vol resets that happen around major events. So right now, the VIX curve isn't that steep, but post FOMC, it's likely to get whacked going into Easter. So you may see a reset like that, which is why you'll see a load of put buying probably on the VIX as we get closer to that as well. Okay, so that's what we're seeing, wings and convexity generally for sale, right? VVIX, which is the implied vol of the VIX, has pretty much hit its local lows again in the 70s. So just something to be aware of. And that is often leading the VIX itself lower, as we flagged. Now, we've been looking at mid-caps recently. You know, we're starting to sense that with the rates repricing that we've seen in the last few weeks, and you know, the hawkish testimony did take terminal rates even higher. Quite a lot's been priced into the rates market in terms of the Fed, you know, being quite hawkish and really having to go higher than we first thought. And the equity market has kind of digested that really well, right? We haven't broken down below 3,900. If anything, we're closer to 4,000. And so the question now is, if we were to start to get weaker data than expected, and non-farm missed, for example, or CPI missed next week, how would the rates market respond, and how would the equity market respond? So clearly, there's a lot of work that has been done in the rates market. So you could get some mean reversion from the kind of parabolic move that we've seen in rates recently, right? So if you've got weaker data, I wouldn't be surprised to see, you know, 15, 20 basis point mean reversion in the front end of the rates market. And if we were to get that, the odds are equities are going to take that quite well, right? So there is definitely some risk building of a bit of an upside squeeze in the face of weaker data that turns the rates market around a little bit away from where it currently is. Even though equities haven't really sold off that aggressively on the rates move, I do think they probably will get bought if rates pull back on weaker data. Okay, so how would we play that? Well, you know, mid-cap, so the Russell 2000 has been the kind of underperformer in the last month. So you can see here that's down around 6%, whereas Qs are down 4.5%, SPY's down 3%, and Dow Jones is down 3.5%. Sorry, SPY's down 4% and Dow Jones is down 3.5%, with UK and Europe outperforming even more. Obviously, China's been worst hit, down about 10, 11. But you can see like mid-caps, Russell 2000, IWM is the ETF there. That did get hit. Now, we look at the retracement levels. We've got a couple of big support levels, one at 185 that we did tag and we bounced off. We've got one at 181 as well if it was to overshoot through there. But in general, we look at our strategy compass. Russell calls seem to be the most compelling calls out of all of the collection that we have there. You know, we've still got Europe looking quite expensive along with Nikkei, which is screening as buy puts. But in terms of all of the other indices that are in buy calls, Russell seems to be one of the best in terms of it's looking quite oversold, low end of the range, plus the vols are quite cheap in terms of where they normally would trade. Looking at our strategy compass, not our strategy compass, our vol dashboard. So as well as being in buy calls, What else can we see? Here we can see that carry's not great. So 95th percentile of positive carry, 8.5 vols. So that's suggesting maybe buying outright calls might not be what you want to do if you're sensitive to that theta bleed, because right now it's not moving. But bear in mind, when you've got catalysts coming up, the history of realized becomes less relevant, because if those catalysts are going to ignite a move, then that's what you need to care about more, basically, right? So that's something to bear in mind. Now, look at a term structure. You might say, well, if I own April calls, for example, and then I sell March calls against it, I can earn a bit of pickup there by selling the expensive March calls that contain the events that are coming up, and own the April calls that are trading at a cheaper vol, and getting to a call calendar that way. And that's something we recommended on Bitcoin ETF yesterday. Call calendars are a nice way of getting into a directional trade, but keeping your bleed down, keeping your theta down in something that isn't really realizing. So for more sophisticated traders, you might want to look at call calendars. Personally, I don't really think it's necessarily worth it. All right, that's it for today. Thanks a lot, everyone, and I'll catch you all tomorrow. Cheers.